All right. So cost management is four activities or four processes, as you can see them highlighted in the red box here. Three of them are under planning process group and one is under monitoring. So you start with a cost management plan, like how are you going to do budgeting? How are you going to do cost tracking? How are you going to account for different types of costs? That's your management plan. Then you're going to start estimating costs. Cost estimating used to be under the executing group because you're kind of working on it. They kind of moved it to planning, but nevertheless, it doesn't matter really. The idea here is you're going to estimate things. You're going to use that PERT formula we talked about to come up with forecasts for each item. And then you're adding it all up to come up with a budget for the project. Once you do that, you start to control your costs by tracking your actuals against your budget. So it's really straightforward. What we're going to talk about are some techniques and methods to come up with estimates and how to track these expenses. All right, so there are kind of three key functions, if you will: the cost estimating that we just talked about and the cost budgeting, which are both in the planning area, and then the cost control. And what you see on the right here is an example of how that works. You have an activity which came from a work item with start and end dates and a resource assigned to it, so it becomes an activity, and you determine a cost for that activity. You forecast it using the PERT formula, and you can aggregate all activities that are under one particular area, for example, outreach or IT work or engineering work or whatever it is. And we call that a work package. And sometimes these work packages are assigned a control account, like a cost center in the organization. So all your outreach work can be charged to your project, but also they're charged to the outreach cost center, to that group, and vice versa. And you can kind of aggregate all of that and it becomes the project cost. Once you have the total for the project cost, we add something called contingency. A mistake that a lot of people do is sometimes when we're working on project plans, we don't understand everything very clearly. We don't know how to do the work, which is normal. And we just fudge some numbers. So, it's like you got someone on your team who's like, I really don't know how to build this web page. It's too complicated. I don't even understand what you're asking me to do. So I'll just give you a number. I'll say it's going to take me 18 hours. Right? And they just picked up a number out of the air. That's not a good way to do project costing or estimates. What they should do is come up with an analogy. I've done something similar and it took me 6 hours. And this is a little more complex, so I think I'll estimate 8. But then at the end of the project, when you roll up all these activities, you as the project manager put in a contingency. Usually it's 10 to 15%. And that gives you a cost baseline. And then the organization as a whole puts another reserve. Usually it's smaller, it's about 4 to 8%, management reserve. These are things that it's a risk mitigation in case market prices fluctuate or the company changes its strategy, or we realize that this project, in order for it to happen, we have to have an entirely new project done before we can do this. Whatever number it is, becomes your budget. So that's kind of the flow of the thought, how you come up with your budget on a project and the reserves that you put. You don't want to put reserves on particular work items. You want to put it on the whole project to spread it out evenly. Putting it on a work item becomes very difficult to track and to figure out where to go back and adjust your reserves, because as you grow in your project, you have more visibility into reality and your risks drop and your reserves will also drop. So at the beginning of the project, your reserve can be up to 15% and it starts to drop as you start implementing. And as implementation starts, it can even drop as low as 8% or so. So you want to be able to change it in one place and not go through 1,000 rows of expenses. Under very, very rare extreme cases where there's a very high risk task or activity, and it very well, you've flagged it somehow, maybe that one in particular, you can give it an extra risk, management reserve higher than the rest of the project. But other than that, it's best to keep it consistent. All right, so that's really it. How to estimate costs are different ways. We gave an example by analogy. I painted this room 2 years ago. It took me 4 hours. The other room is a little bigger, so I think it'll take 4.5 by analogy. Or we did a crisis line in 2021. It took us 400 hours. We're doing a call center in 2022. It's similar. We think it's going to take us 380, right? So by analogy. You're comparing an apple to a similar apple kind of thing. The parametric modeling is a rule of thumb. You say it takes $5 to paint a square foot in a room on average. And I have a room that's 1,000 square feet, wall space, or wall area, then I will multiply 5 by 1,000. That's my cost. So it's following some formula, rule of thumb. That's kind of an average, it gives you a relatively accurate number. There's another way called bottom-up estimating. You estimate for each task at a very individual level, then you sum it all up to get the total for the whole project. It's more detailed, it's more accurate, but it also takes a lot more time. So if you're working on your charter early on in your project, very early on, you're working on your scope, you can probably use the analogous or the parametric modeling techniques if you know the rule of thumb. If the project is something completely new, like the organization has never done something like this before or similar to it, you might not have a rule of thumb. Sometimes there is a rule of thumb in the industry, like the example I gave about painting a room. How much does it cost to do a roof on a house? There's some standard numbers, $12 per square foot, whatever it is, and you multiply it. But if it's a completely new thing, you'll probably have to do a bottom-up estimating. And some of the tasks, when you come up with the estimate for the cost, you can do analogies with other similar tasks that you have come across in the past. So the first way is to compare an apple to a similar apple. The second one is using an equation, a formula. The third one is like building a pyramid. You're starting from the base all the way to the top. The last one, which is bid analysis, what we talked about earlier, RFPs and RFI, RFQ. RFQ is request for quotation. You're not so interested in the technology. It's like something you already know how it works. Let's say you already have been using Zoom for a year, you know it very well, and you just need to add another 100 licenses for your staff. You don't need the vendor to spend time to tell you what Zoom is all about. You've been using it, you're an expert in it. You're basically shopping around, going to 4 different distributors of Zoom and asking them, hey, give me quotations. If you were to give us 100 licenses, what would it cost? So it's an RFQ, it's like an invoice. They give you, the unit cost multiplied by the quantity. The RFI is more technical. The RFP is both technical and cost information in it. So those are the 4 common methods to kind of come up with your estimate.
Excuse me, Elder Nasser. So these are all ways of estimating how much money we're gonna have in our budget and how much money that we're gonna have to spend, right?
That's correct. Right.
I mean, there's the PERT method, which I feel like is actually would actually be really good for. I feel like that one would be really simple because you just have to add up how much P is, the most pessimistic, the worst possible scenario, plus 4M, which is most optimistic. I get the most, I guess, most likely, plus O, which is the most optimistic. Divide that by 6, and then we'll be able to get how much. We'll be able to know how much, how much money we'll have to spend, or how we'll have to spend.
Right. So you would use the PERT formula, or you need the bottom-up estimating when you start things from scratch. With analogous and parametric, it's unlikely that you would use it.
Okay, so analogous. What exactly is analogous and parametric again?
Just using a cost in a similar project. So you did a project that involved sending 10 email campaigns. This project involves 3 email campaigns. So you say it's going to be about the third of the cost of project A, something like that.
So basically, like comparing what we have to do in this project to like another project if we've done something like this before.
Mhm.
And parametric is what again?
It's using a formula.
Using a formula like the PERT method.
No, PERT method would be for the bottom up. Parametric would be more, um, it's a formula for rules of thumb in the industry. So we know that it takes 20 minutes to do an email campaign. So we're just, if we got 10 email campaigns, it's 20 times 10. Or we're painting 6 rooms and we know it takes an hour to paint a room. So it's going to be 1 times 6. That's what parametric means. All right. But they already used, whoever came up with those rules of thumb, already used the PERT formula to calculate this, the 1 hour and the 6 hour and all those numbers. So the only time you as a project manager use the PERT is in the bottom. And you guys will get to practice this more. So don't worry too much. Let's not get hung up on the details. You guys can practice that. But let's move on because we're a little behind here. When it comes to cost budgeting, you want to include resources, meaning your people, your machines, software you're using, licenses, anything like that. You also want to account for some income that might be coming from your project as you are still working on it. Some projects sometimes would bring in income before the project happens. For example, if you're doing the job fair, you might have people signing up and paying the fee to attend the fair before the fair even started. That's income that you can use to move to invest in your project. You want to aggregate all the costs. You can also classify them by cost center in your organization, by type of activity, and of course, by requirement or work item on your task, your spreadsheet. If you are traveling or have other expenses, you want to include those as well, not just labor or direct cost. All right. There's something important here I want to share. It's called earned value management. This is an advanced topic, but it's interesting. As you're working on your project, the project is earning some value through the work that the team is working on. So for example, think of it this way. You are working on a crisis line project plan. You put a plan together. The whole project, let's say, is valued or costs, hypothetically speaking, let's say $1,000. The team, and $1,000, and it's going to take, let's say, 10 months to do. And let's assume the team is working uniformly. So every month they work the same number of hours and they accomplish the same output. If the team has been working for 2 months and they've accomplished all their deliverables and they have been on time, it is as if they have earned 20% of the project value. It's as if the value of the project at this point is $200. If they were, theoretically speaking, were to sell this project to someone else, they can say, buy it from us for 200 bucks, right? So at the beginning of the project, they had $1,000 in their bank account that the sponsor gave them. They worked for 2 months and developed some stuff. They invested $200 actual expenses. In the bank, they still have 800. They've earned 20% of the value of the project. So we call that earn value. Depending on how fast or slow they are in their schedule, that number could change. So if in 2 months they did not achieve their deliverables, they were behind by 50%, that means over 2 months, the earned value is only $100. And they are behind because they should have earned up to 200. So they are negative, their earned value is negative 100. It's a method that's used on big projects to see how much value the team has accomplished on a project. For most small projects, we don't use it because it's not worth the effort. It does take quite a bit of time. The last thing we want to talk about here real quickly, 2 things, something called the total cost of ownership. How much does it cost the organization to implement and own the deliverables of the project? So an example here, if you buy, let's say, a vehicle to use in your job fair project, let's say you're going around meeting with partners and things like that, doing promotions and business development. So you need a vehicle for your team to go meet these partners. There's a cost for the vehicle, $10,000. You need to add some accessories to it, so $1,200, some other things, $2,400. You pay for sales taxes, insurance, property tax. So all of this is part of the cost. And then there's some other things. If you want to get rid of that car one day, you might need to pay some money for someone to, to tow it away, some fees to take care of things, whatnot, and so on. So we call this total cost of ownership. The nice thing about it, it tells you the total cost of your project over a period of time. Usually for most projects, we use 3 years. It includes the time where the project is not yet live, it's still in development, plus whatever period of time after that where it's operating up to 3 years. Because it helps us budgeting. The CFO likes this. He or she knows how much they need to budget for over the next 3 years. But it doesn't tell you the value of the work that you've done. So there's another approach called return on investment. So here's an example of total cost of ownership before we move over to return on investment. It's the total direct and indirect costs divided by some unit time. Usually that unit time is a year. Here's 3 different examples. Different components have different costs, and you can calculate the per year cost. In this case, number B, you want to divide it by 2, the total, to compare apples to apples. But it tells you the total cost of ownership, everything together. All right. The other approach, which is a little bit more meaningful, is the return on investment. So we spent $1,000 for this project, but what did we get back in return? Did we get 1,000 or 2,000 or 500? That tells us how efficient and successful our project was. The TCO does not tell you that. It just tells you everything you're going to spend, so you know the limit to spend. But it doesn't tell you if that spending was a good, wise decision or not. The ROI would give you that idea. So it tells you the earnings of your project divided by the cost of your project. In some cases, like a case of a crisis line, it's hard to quantify the earnings because you're not necessarily getting any income. So you can use other types of income to find out. For example, if you're receiving grants to support the crisis line or donations that came in indirectly because people like the cause and they want to support it, you can account for those types of income and consider that to be part of your project earnings. Plus, you can quantify the mission value of the service. So if you save 10 lives over a month, you can come up with some formula or way to quantify the value, the economic value of the life. Of course, there's some other intangibles that you can't just quantify. I mean, a life is sacred. It has really no value. I mean, it has so much value that it's meaningless to quantify it. But from a financial perspective, there are ways to quantify things like that. All right, so those are 2 key things. This slide talks really quickly about the cost variance that we just mentioned, a part of earned value management. It's how much deviation have you experienced from your budgeted activity. So we call that the cost variance. It's the difference between your earned value and your actual cost. If your earned value and your actual cost are equal, you have no deviation. So the CV will equal to $0. But if your earned value, let's say the example I gave, is $200 after 2 months, and your team was so efficient, they spent only $100, that means your cost variance has a positive of 100. You guys have actually saved $100 or 10%. But if it's the flip, the other way around, they weren't that efficient and you had some unknown expectations and they spent 400 instead of 200, then you have a cost variance of negative 200, which means you're 20% behind on your cost. You're over budget by 20%. The same concept applies to schedule variance. If you are a student and you need to study 10 chapters over 10 days, and on day 5, you completed chapter 5, that means you're on schedule. Your variance is 0. But if on day 5 you finished everything, that means your earned value is 10 chapters minus the planned value, which was only 5. I planned only to finish 5 by the 5th day. then I have a schedule variance of +5. That means I'm 500% ahead of my schedule. So these are just concepts to kind of quantify the value of a project compared to time and cost. All right, we'll pause here, see if there are any questions before we get back to our activity.
So all those like methods, actually, Brother NASA, do you think that like after this is all over, after we're done here, like all right, 4, do you think that you can like come at around like 5 and you can like look at the slideshow together so that way you can explain some of this stuff to me, like the cost estimation stuff?
Yeah, so remember, we still have 8 weeks of coaching. So when you work on a real project, you will work with a coach and you will get to ask more detailed questions and practice specific things. And then each person will be different. Some people have weaknesses in cost, others scope. So that's when we will tackle these types of things. But for now, you guys have covered quite a bit. I have a book next to me here. It's about 600 pages big. I don't know if you can see this. This stuff we covered today, people typically excel in it over 20 years. It takes them 20 years to get to a level where they're experts in it. You're not an expert yet, but you have the equivalent of probably 2-3 years of work experience, just that from a knowledge perspective, just from the 2 days. So don't feel too worried if there's some details you didn't catch. It's all about practice and putting it all together through a hands-on activity. So as you continue your online job fair activity together, you'll get better handle, like you mentioned earlier, about the process.
I know. I would still like to talk to you as soon as I can. Maybe around like 5:30 tonight. Like we can like set up like a Zoom meeting if you're available at like 5:30 later today.
Okay, let's take that offline. We can, yeah, arrange something, no problem. All right, any other questions on cost management? Okay, so what we're going to do now, we will break into groups. We'll go back to your work group. Before you jump into cost, go back to your scope. Make sure it's more clear, it's more refined. You have clear objectives. You have SMART goals with very measurable, specific, and time-bound pieces of information. You want to start to write a scope statement. It's got to be crystal clear to anyone walking on the street. Think of a 16-year-old who's walking on the street and he sees your scope statement on a billboard. That person should be able to understand exactly what is happening in 5 months. All right, that's your scope statement. It's a very high level generic statement about the whole project, why it's being done, what you're trying to accomplish, and by when, and basically it summarizes the objectives and the goals. Once you clean that, go back to your RTM. Make sure you have a good number of requirements, at least 4 or 5, that reflect your objectives. And then for each one of them, make sure you have at least 2 work items on this other tab. If you want, you can add a column here and you call it requirement reference. And here next to task 1, you could say requirement, R1.1. This way, you know that this task is related to this requirement. You can do that. Again, these spreadsheets are meant to be flexible to adapt to the needs of the project. Once you complete that, then you can work on columns H, I, and J. I know you guys worked on it a little bit earlier just to get a sense of it, but now with more understanding of how to come up with these estimates and how to kind of tie everything together, it should be easier to visualize the bigger picture. All right, so we have till 4 o'clock to do this, which is about an hour and 5 minutes or so. So let's go ahead and get started unless there's some questions, and I'll be jumping in between rooms to kind of answer any questions and so forth. But the goal by the end of the day, the next hour, is to have, again, all your objectives complete, at least 4 of them, and at least 4 goals that map to these objectives, at least 1 to each, if not more, and at least minimum 4 requirements, and again, 4 work items with their cost, their schedule, and all that good stuff. In Excel, if you need to change the dates, all you need to do here is just, you can put 110, not Excel, I'm sorry, Google Sheets. And let's say if you want these columns to be weekly, you can put here 117, 124, and then just grab these 3 and drag them all the way. It's going to set it up for you properly. And now you have a weekly schedule. If you want to do daily, which obviously is going to take a lot of columns, just change it 110, 111, 112 and do the same thing. So there's some flexibility there, but you want to have a real project plan, something out of, that's kind of complete, 4 of each of these things. And then when you're all done and good, go to your charter and start populating this whole sheet. So by 4 o'clock, this charter should be complete. It's ready to present to your stakeholder, to your sponsor, to say, all right, this is what we are going to work on as a team. It includes our assumptions, some KPIs, resources. Your sponsor is not going to look at anything else. They're only going to look at this sheet. And based on what you're putting, they're either going to accept it or not. And you will move on from that point. So this is kind of your authorization to start your project.
Excuse me, about like sponsors. Sponsors are obviously, what exactly are the sponsors in this case? Just
The
in
sponsor
general.
is the person who is funding the project. So in this case, you can assume I'm the sponsor. Let's say, hypothetically speaking, I have some money that I want to invest for this social cause to help a group of young people, develop themselves. And this is basically my request to your team to make it happen.
All right, sponsor.
So your charter should address anything that's in this scope of work. Plus, it should include a little bit about the cost. So let's look at the charter. Let's see what's in it. Yeah, we need to add here. We can copy these 2. You need to add the cost in the schedule. So here you would have cost, and schedule would be basically your start and dates. I think that's at the top. Yeah, you have your start date here. So it will be your start date, your end date, and total number of hours.
Wait, did you say you said something about the sponsor themselves seeing like just like the charter? We send it to them, and they're gonna like look at it to like see if it's all in order.
Mm-hmm.
That's part of like I think the verification part, the verification phase of this.
Yeah, it's part of our approval. So you really can't move on with your project without your sponsor's approval, right? They won't give you the money. They need to know this is your agreement with them, right? So you got a request, which is what's in the slide. You're coming back to them and saying, all right, here's what I can do. Here's the charter. It's like an internal proposal, if you will. And if everyone agrees to it, the project starts. If people don't agree, whether it's the project team or the sponsor, the project won't start. All right, let's go get started so we don't lose time. And obviously you can ask more questions as we go through this. So I'll talk to you guys in the room.
Assalamualaikum guys. Like some.
I actually have to drop. So, does anybody here volunteer to want to take up project manager role?
Wait, I thought, aren't you the project manager?
Yeah, but I actually have to leave because I have to go somewhere.
Oh, right. Okay.
Me and Abdu Omar, we could like both kind of split the job. If you want to do that, Abdu.
Yeah. Okay.
Yeah, I don't think I'd be able to take. I don't think I'd be able to take on like the full job of the role. If we could like try to split it or something like.